Good afternoon. This is Chris Robinson, Robinson Ag Marketing, with today's closing comments for grains and livestock, Tuesday, the 22nd of July. Well, disappointing day in the grains and another rewarding day in the protein complex. Let's get started off with December corn. December corn settled down 4.25 cents at 4.18 even. The risk is here. We go back down and retest that 407.5 contract low from 2 Mondays ago. If you are a subscriber, if you are a client, I did email out and text everybody today specific recommendations for how to defend unpriced 2025 corn. My suggestion was to do it for 66 days using an October option. We were paying around 9 cents a bushel for a little over 2 months worth of protection to have a 410 floor. So if you take a 410 put and you pay 9 cents for it, even after the price of the put, you are locking in 401 corn, worst case scenario. And that protects you for 66 days till the last week in September. Again, it is an October option. It is just one choice. You can do more time, less time, in my opinion. That's what I would use if I was a producer. Now, everybody out there is in a different situation. Some people sold stuff up at around 470. Some people haven't sold anything yet. And if you're looking down this barrel here at, what happens if we go under $4 corn, I would say that the 410 put for that amount of money is a good risk reward. Best case scenario would be you pay your 9 cents for your put option and corn rallies up to 470, right? That would be a 50, 60 cent rally. I would gladly lose 8 or 9 cents in a put option and pick up the 50 cents in the cash market. If you're a producer, that is a hedge. That's exactly what we're hoping to do. Now, vice versa, if 66 days from now we're sub $4 and people are talking, about 380, 375, something that would really upset quite a few people, having a 410 floor to take the sting out of it. So that's the hedge we were looking at here today. That's what I would suggest. The crop conditions came out Monday night yesterday, and it was the best crop conditions for this time of the year in 9 years. That takes us back to 2013, 2014. It was the best crop conditions for soybeans in the last 5 years. So the crop is not under stress. I know it's easy to if you're in a situation where you don't have the best weather or you're looking out your back window and it doesn't look that good, it's easy to be concerned. But the market is looking at the overall fact that we have large acres planted with no stress, and that is going to equate to a higher yield. Now, I don't get into the arguments of what the yield is going to be. Is it going to be 181 like the USDA says? We'll find out when the harvest is over. In the meantime, all we can do is defend what we can defend. So I would suggest doing that. If you're looking for help, give me a call. I can explain it again, exactly what we're doing. But that was a suggestion went out today for all clients. Now, flip side, November soybeans hanging in there at 10.25. 10.18 is a very big number. It's the halfway point of all available prices since the December low at 9.60, and then our February and June highs are basically around 10.76, 10.79, what have you. So that's a big level. So that's still hanging in there. And although the funds are short, corn, wheat, and beans, they're not massively short. They can flip very quickly, especially soybeans. And everybody knows that soybeans are not made till August. Here it is, July 22nd. So we're going to head into that time of the year. Because of that uncertainty, soybeans continue to have a bid. And then you can't talk about soybeans without talking about bean oil and canola. Those continue to be near 2-year highs. That's a great marketing opportunity there if you grow canola or if you're someone that grows sunflowers. Those are in the midst of all this negative stuff with corn, wheat, and beans, to have canola and bean oil near 2-year highs, that's an opportunity. Switching over real quickly to wheat. Wheat did manage to end the day up higher, up about 6 to 7 cents across the board. December Chicago wheat, although I'm still talking about September. We'll talk about September for another 10 to 12 days or so, but it's hanging in there. I mean, the key level for September Chicago is if this 533, 534 level holds. If that fails, then the risk is the 521 contract low. Switching over to KC September, 515 is the number that matters, and it was nice to see we traded that as low down as as low as 520 and 3/4 today. We did finish today at 533, up 13 off those lows, up 7 on the day. So there's a silver lining there too. I mean, if you're trying to pick a bottom, it's pretty easy to figure out what it is. It's 515. It's the low that goes all the way back to May. We hit it again in June. And that's sort of the line in the sand there. So if you're a bottom fisher or if you're a producer, that's the level that you have to contend with. And we'll move over very quickly and finish with the livestock. Live cattle finished slightly lower, but not after making new highs. August live cattle hit 225.725 today. If you look at that, continues to just creep out, making new highs. At some point, we're going to correct, but that has just been, the continuous bull move. The deferred months were all higher. You had Feb, April, and June all up 25 to 50 cents. Switching over to feeder cattle, again, we had August hit 329 and change today on a high. If we take out 330, that opens the door up to even higher prices. If you look at September feeder, we hit 329 and 329.5 was the high. We did finish down at 328.5, but only $1 off those highs. Again, the market just keeps moving higher. Stock market keeps moving higher. Cash market holds up. It seems like no matter what gets thrown at the cattle market, it continues to rally. We're going to have a cattle on feed at the end of the week. I can't remember the last time was a cattle on feed data dump really impacted the market. So again, if you're a producer, capture the revenue. How do you capture the revenue? You use a put or a put spread. That's something we do all day. If you buy the put, it keeps the upside open. Certainly has been a better decision for anybody that is long cattle and wanted to hedge, because if you're using futures to hedge your cattle, you've been on a first name basis with the margin clerk here really for the past 10 months, going back to September. And finally, with the lean hogs trying to turn around again and make a new run at the contract highs. Again, I think it's kind of getting dragged up by the new highs in cattle. I will say this, if there is any sort of bad news regarding either the outside economy or any sort of trade news, probably the most sensitive would be lean hogs. But for now, you've got August lean hogs trading 108 on the high today, finished at 107 3/4. If you look at August, is there a chance we're going to go back and retest the contract highs? If that happens, you've got to keep, you're talking about 113, 114 again in your gun sights. So all in all, a good day in the protein complex. Continued worry about where is the bottom going to be found for new crop corn? How many bushels of corn are we actually going to grow? What is the yield actually going to be? I learned a long time ago in my 30-year career to not worry so much about the what ifs. Defend what you can defend. And, your main position, if you're a farmer or producer, you're a bet long. So I want to defend the downside, but I sure want to keep the upside open. I sure want to make sure that if we do get a bounce back up to 460 or 470, if we do go see those spring prices again, that we haven't gummed up the works by selling calls to buy puts or anything like that. Keep your upside open. The next 6 weeks are going to kind of, is where the rubber is going to meet the road. We'll see, and we'll see together. So in the meantime, defend 410. That's my suggestion. Call me directly, email me directly. Have a great rest of the day. This is Chris Robinson. Have a good night.